Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Europe podcast, available every morning on Apple, Spotify or wherever you listen. It's Tuesday the 29th of October in London. I'm Stephen Carroll. Coming up today, HSBC's profits beat estimates as the bank's new CEO announces a $3 billion share buyback. In an exclusive interview, Goldman Sachs CEO David Solomon reveals he's bullish on the outlook for M&A. Plus, the UK's energy industry prepares to do battle over free electricity. We have a special report. Let's start with a roundup of our top stories. HSBC has reported better than estimated earnings and a fresh stock buyback just days after unveiling a major restructuring plan. Third quarter pre-tax profit rose by 9.9% from a year earlier to just under $8.5 billion. Europe's largest bank says it will now repurchase shares worth up to $3 billion. Bloomberg's Jemana Bersetchi breaks down the rest of the numbers.
Third quarter revenue coming in at $17 billion versus the $16 billion estimates or thereabouts. CET1 ratio sitting quite healthy at 15.2% versus 14.9%, so still sitting on a ton of capital. In terms of their guidance, CET1, they see it within the medium-term target range of 14 to 14.5%. Target cost growth of about 5% for 2024 versus 2023. A lot of focus, of course, on HSBC cost guidance, given the restructuring announcement that they came up with.
Jemana Bersetchi speaking there. CEO Georges El-Hedri, presiding over his first set of earnings since taking up the job, said in a statement the results show the bank's strategy is working. HSBC last week unveiled its biggest revamp in at least a decade, including merging its global commercial and investment banking divisions and making the Hong Kong and UK businesses into standalone units. One of Europe's other biggest lenders, Santander, also posted better than expected earnings with continued growth in interest income and rising revenue from fees. The Spanish bank posted third quarter net income of €3.25 billion versus estimates of €3.17 billion. Net interest income came in slightly below expectations at €11.23 billion. The bank says it's confident it will deliver on all targets for the year. A growing number of money managers are watching metrics on social instability in China to try to predict how far President Xi Jinping will go to stimulate growth. In September, Morgan Stanley debuted a new distress gauge that could be used to predict policy swings. The bank says the measure is currently nearing the low levels reached at two previous junctures. Those are in 2015, when Beijing took drastic steps to end a $7 trillion stock market rout, and in 2022, when the country abruptly dropped its COVID controls. Goldman Sachs top executive sounded a bullish note on the outlook for deal-making, singling out investments in technology as a bright spot. David Solomon has told Bloomberg that AI is likely to power a new wave of deal-making.
I think the regulatory environment has been a headwind to some deal-making. Obviously, with an election, we could see a change in that context, but there's no question the deal-making environment is improving. And when you look at what's going on with technology and the investment that's necessary, to power AI, I think that's a tailwind for deal-making over a period of time, too.
Solomon was speaking to Bloomberg on the sidelines of the Saudi flagship Future Investment Initiative in Riyadh. The global bank boss was there to open a new office in the capital, deepening its presence in the largest Middle Eastern economy. Volkswagen plans to close at least 3 factories in Germany. The unprecedented move is part of a wide-ranging cost-cutting push, which also includes a 10% across-the-board pay cut at its main VW brand. Bloomberg's Oliver Crook has more from Berlin.
This is a company that has never in its history once closed a factory in Europe. We're talking about closing 3 in its home country right now of Germany, potentially 1 in Belgium as well. And of course, this will mean potentially tens of thousands of job cuts. So again, just to reiterate, Volkswagen talking about closing 3 German factories for the very first time in its 90-year history in Germany.
That's Bloomberg's Oliver Crook. He says the announcement kicks off a tough week for Volkswagen. The car maker is expected to post declining sales and profits when it reports third quarter earnings tomorrow. The European Central Bank's Vice President sees substantial risks to the inflation outlook for the euro area. Despite significant progress, Luis de Guindos says policymakers can't declare victory just yet. He added that geopolitical conflicts threatening to push up energy and freight costs, and that extreme weather and sticky wage growth all have the potential to keep price pressures higher for longer. De Guindos was just one of a few ECB officials who hadn't commented on the future interest rate path after the central bank lowered borrowing costs in mid-October for a third time this year. In a moment, we'll have the latest on all the morning's earnings, plus bring you an exclusive interview with the Goldman Sachs CEO David Solomon and look at why some companies are against plans for free electricity in the UK. But first, another story that caught my eye this morning. Have we reached peak croc? This is an increasing number of schools in the United States are banning the shoes for what they say is safety reasons. Our colleagues have tracked this in at least 12 states. The head of the Crocs brand say they're not aware of any data showing that bans have increased, but it could be a key factor when the company reports earnings later today. Sales more than tripled over the past 3 years, boosted in particular by demand for children's shoes during the pandemic. But that estimate, or that growth, has slowed. Bloomberg estimates compiled show that growth expected to slow just to 0.4% in this quarter, which includes the key back-to-school periods. That could be an interesting test for what some consider a fashion icon, others a fashion menace. Well, let's turn now to some of the company results we've had out this morning. Our equities reporter Joe Easton is with us for more. Joe, let's start with HSBC. We heard from them a little earlier this morning. Shares in Hong Kong reacting positively.
Yes, a pretty decent gain for those shares, up around 3.5%, as you said a moment ago. Now, HSBC doing another big buyback, $3 billion worth of stock they're going to buy back. They've reported a 10% jump in pre-tax profit from a year earlier to around $8.5 billion in the last quarter, mostly driven by the wealth business, benefiting from more money being put into that unit from Asian clients, and also the FX business, the trading business, which is one of the biggest FX trading units in the world, doing really strong earnings as well for that business. That share price has actually risen around 20% over the past year already, so it's looking to add on to those gains today. We'll wait to see if they continue in London this morning.
OK, and staying with banks then, Santander also a beat, not quite as dramatic though.
Yeah, so Santander numbers coming in better than expected. Now, this is due to mostly their fixed income and also their interest income, both rising. So fixed income in terms of the fees they make in that unit, and also just the higher lending profits due to the higher rates, boosting that stock. But the interesting thing to note is the company saying that they've delayed the UK part of their earnings because of Friday's motor finance ruling, which we covered yesterday. So this is a ruling where a court said that lenders hadn't been transparent enough when brokering these deals for people to take out car loans, and therefore there are expected to be significant compensation payouts. One analyst saying Santander could be on the hook for around £1 billion worth of compensation. So Santander saying in a statement that they haven't been able to work out in time for the results how much this is going to cost them, so delaying that part of the report.
Yeah, very interesting. I'll be watching with interest to see what those numbers reveal as well. You've plenty more company results to pick from, Joe. What else are you watching?
Yeah, so I've got my eye on Deutsche Lufthansa. Those numbers actually just coming out a few moments ago. Lufthansa does look like a beat on the headline profits, but some weakness in some of the EBIT numbers, some specific earnings numbers that we look at dropping slightly. Passenger numbers seem to have actually dropped a little bit in the last period as well, potentially maybe due to the higher fares that we've seen, though we are expecting fares to start coming down, thankfully. The other one I've got my eye on was Novartis. Now that does look strong actually. Novartis over in Switzerland, one of Europe's biggest pharmaceutical companies, do a lot of respiratory drugs, looking like they're beating on all of the top lines in terms of the report that's just hit the wires for that one. So that could be a strong one in the pharma space this morning.
Yeah, indeed. Looking at into the details of the Lufthansa results, it is interesting to see that in terms of future looking, they're talking about passenger demand being above levels seen last year. They're planning to increase capacity in the fourth quarter, and the company expecting to report positive operating profit for the final 3 months of 2024 as well, and they're expecting air travel demand to remain strong. So some positive signals for the future coming out of that major airline group. Joe Easton, our equities reporter, thank you very much for joining us, and of course we'll have plenty more on those throughout the programme as well. Let's turn now to one of our top interviews this morning from Saudi Arabia's Future Investment Initiative Summit. Bloomberg has been speaking to CEO of Goldman Sachs, David Solomon. Our Horizons Middle East and Africa anchor, Jumana Bersachi, has been speaking to him. Here is the exclusive interview in full, starting with David Solomon's thoughts on Saudi Arabia as an investment destination.
We are excited to be opening up a new office in the financial district, and I would say we are committed to our presence here in Saudi Arabia. I was reflecting, last night around the past 7 or 8 years that I've been coming to this event, and just watching the progress here. And the progress has been meaningful, and we've participated in that progress. It's interesting to watch our clients here on the ground participate in that progress and be in a position to try to help them. But also, as you look at the international community is more interested in what's going on from an economic development perspective here, and we're delighted to be positioned to help our clients in this region.
Yeah, and it feels like there is so much deal making. Even IPOs last year was a great year in terms of activity across all these exchanges, which means also more and more banks are looking to get involved in the action. Are you finding it difficult to retain and attract talent given increasing amount of competition?
We have a very, very deep bench of bankers around the globe, including, here in the region. We have a number of bankers from the region that base out of London and sometimes move back to this region. We've been able to attract talent. We're Goldman Sachs. We've been able to attract talent here in this region and other places in the world. I do agree there's more competition here, but that's a positive. Actually, the levels of activity are picking up, and I feel very, very confident in our ability to have really extraordinary people on the ground here to serve our clients very well.
One of the stories that our Bloomberg News team have been reporting on is the fact that the PIF have been sort of refocusing some of their investment efforts domestically, which means that in terms of the relationship with asset managers in the region, there's been a lot more focus on or questions asked about what some of these asset managers are delivering on the ground within Saudi Arabia. How do you think that is going to shape up the asset management ambitions within the region and specifically within Saudi Arabia?
It's a very, very natural progress, and we've been talking about what's going on here in the kingdom. But the level of investment in diversifying the economy here in the kingdom is significant. And of course, that's a significant focus of the PIF. For a firm like Goldman Sachs, where we're well positioned to serve as an investment banker, to serve as a trader, to serve as an asset and wealth manager, I think the firm's incredibly well positioned to help in this part of the world, regardless of the trajectory. So we're excited about what's going on here and excited about the opportunities we'll have to help serve our clients here.
Can I ask you what your level of concern is vis-a-vis the geopolitical situation in the region right now?
I'm concerned about the geopolitical situation in the region. It's not good for security. It's not good for safety. It's not good for economic growth. And I'm hopeful that leaders both in the region and around the world and important governments around the world will be able to find a path to settle it down as we move forward. But, of course, anytime you have geopolitical uncertainty, that's not good for economic growth and prosperity. And one of the things I just noticed, I spend time with people here on the ground. People want to find a path to a secure, prosperous, economically vibrant Middle East.
Has it impacted business trading in the region?
It's interesting. People are obviously concerned and very, very focused, but it's not had a significant impact on activity up to this point, on activity in this part of the region.
Yeah. Well, let's just talk more broadly. Your earnings came out very strong, surpassing expectations. Obviously, the stock has had a good run this year. You must be feeling good, but let me just ask you how you're feeling about the outlook in general.
I feel good about the outlook. I think, if you took a tour around the world, the U.S. economy is actually doing quite well. It's been very, very resilient. I'm a little bit more concerned about European growth and also the economic situation in China. But overall, the engine of the U.S. has been quite powerful, and our business, while global, is quite correlated to U.S. growth. I can give you a list of things to worry about, but generally, I can tell you also a list of things that I'm quite optimistic about.
Yeah.
The progress around technology and AI and the opportunities to increase productivity are real. Progress that we're seeing around healthcare and medical technology are extraordinary in the impact that they'll have. So there are a lot of reasons to be optimistic about the growth and trajectory of economies around the world.
Yeah.
But there's also fragility and things can go wrong.
Well, I was going to pick up on that because it's been really difficult to sort of track the narrative around the U.S. economy the last few months because we've gone from hard landing to soft landing. Now people are talking about no landing. I'm not going to ask you for a descriptor of the U.S. economy, but what I will ask you is where are some areas of concern that you're seeing right now?
Well, the base case in the U.S. is certainly at this point for a soft landing. That doesn't mean that at some point there can't be, some sort of a slowdown in economic growth. But what I would say is the U.S. economy is proving to be incredibly resilient. We do have an election in the U.S. and there'll be policy decisions that come out of that election. And so, certainly those will have an impact on the trajectory in 2025 and 2026. With respect to, European growth is more sluggish at the moment. And I'm concerned about the same things that many people I know are talking to you about at this event. Geopolitics, U.S.-China relationship, the situation in Ukraine, the situation we just touched on in the Middle East. Also concerned, broadly about inflation in the world, concerned about energy policy, which is obviously a significant issue. I'm concerned about immigration and migration, which is an issue in different parts of the world. So these are all issues that require leadership and policy direction. And I'm hopeful as we get past the election in the U.S. and we continue to move forward, we'll see a clear direction of travel on some of these significant policy issues.
Well, the other big development is obviously the Fed have started cutting interest rates. And I think you were asked about what your expectations were for the Fed the last time, and you said a 30% chance of a 50 basis point cut. So we'll give you that. They went for the 50. But what matters more, do you think, for financial markets? How quickly they go or where they end up eventually?
I think there's an awful lot of attention on short-term rates. I'd actually be focused over time on longer-term rates. And, I continue to be concerned about the level of spending and deficits in the United States. I don't think that's a short-term, crisis factor, but unless we have policy change and get our spending and our debt under control, ultimately that's going to have a bigger impact on long-term rates than I think people are anticipating today. With respect to the short end of the curve, I think it's going to be very data dependent, and that data will be driven in part by what kind of policy we see coming out of the election. Yeah. And so I think it's important to watch carefully. It seems like the Fed has been relatively transparent that we'll get another interest rate cut before the end of the year, but after that, I think it will be very data dependent on what kind of policy implementation, what happens to growth, are the inflation numbers actually improving further? Those are all things I think the Fed will be watching carefully.
Can I just circle back to your first point vis-a-vis spending, though? 10-year Treasury is trading around 4.3%. Do you think that is adequately pricing in the fiscal premium in the years to come in the U.S.?
The market's the market, and so it is absolutely pricing in the premium that the market perceives today. What I would just say, if you look at the trajectory of our spending and our debt and the interest burden that we have, I think over time is through the rest of the decade, et cetera, we'll have to bring new buyers into U.S. Treasuries, and that will potentially have a risk of putting pressure on longer rates, unless we want to finance the whole Treasury stack at the front end of the curve, which would be a very, very significant policy shift.
Yeah. I want to ask you a little bit more about your trading numbers, because they came in very strong, stronger than expectations. And earlier on, you had guided that fixed income trading was going to see declines. But overall, for the quarter, you ended up posting quite strong trading results, namely on back of your equity trading business. Was this sort of a one-off because there was so much volatility in equities this quarter, or can we expect that momentum to continue?
Our equity franchise is performing very, very well. We have the leading equity franchise of the big banks. It's something we've invested in and built over a long period of time. I can't tell you quarter to quarter what the market environment will put up for that franchise, but we are positioned very well to serve our clients and have a leading share position in that business. When I commented about our trading revenues in early September, at the very beginning of September at a conference in New York, the business was softer. It had been softer in August, particularly in fixed income. We had a very, very strong comp from the third quarter in 2023, and ultimately our fixed income business was softer year over year. But I did say when I made that comment that it would be very, very dependent on what happened in September, and we actually had a more robust September than we expected.
Yeah, a lot of volatility volatility in the markets, do you think you can continue to gain market share on the trading side?
We do believe there are opportunities for us to continue to take share, although we're operating in a leading share position, so those gains will not be as pronounced as they've been over the last 5 years. But we think we have a very, very powerful ecosystem in our global banking and markets franchise. Our One GS operating ethos is helping us serve our clients in a very, very forward and exceptional way. And if you are patient, you take a long-term view, you earn trust, you show up for your clients in good times and bad, over time you gain share in these businesses, and we're very focused on that.
What does the outlook look like right now for deal making?
The outlook for deal making is improving. I talked on our earnings call about the fact that our M&A backlog had improved. I talked about some headwinds, particularly on the regulatory side. I think the regulatory environment has been a headwind to some deal making. Obviously, with an election, we could see a change in that context, but there's no question the deal making environment is improving. And when you look at what's going on with technology and the investment that's necessary, to power AI, I think that's a tailwind for deal making over a period of time too.
Yeah.
A lot of change, a lot of opportunity, and when there's change, leaders are constantly looking to make sure that they're positioned strategically to have a leadership position as the world evolves.
Well, I know you've also been making a big push into your alternatives business. Private credit is an area of focus. What is the opportunity that you see there? Because it really feels like that has become the major focus of the market. Many, many different players are looking to get involved in that space.
Well, we've been in the private credit business for over 30 years. Yeah. We have $140 billion of private credit assets. We've been a leading private credit player since the 1990s. What I would say is there continues to be secular growth around the opportunity set for additional private credit formation, and we're very, very well positioned, given the way the firm sits, to be a very, very unique player in that. Obviously, in our asset management business, we manage significant private credit assets, but we also have one of the leading syndication franchises, so we have an ability to originate and distribute in addition to be an investor through our asset management business. That's a very unique combination. I think it positions our firm very well. And you will see, in my opinion, continued secular growth in private credit formation. I still think we're early in that cycle.
What do you think lower interest rates do for the private credit landscape, though, given so much of the debt is floating?
I think that private credit, it's not immune to lower interest rates, but there are different ways that we can finance activity. And private credit's a very important part of that. People use private credit as a very, very broad term. Are we talking about insurance companies financing investment-grade companies? Are we talking about investment-grade financing? Are we talking about below investment-grade corporate financing? Are we talking about direct lending to small and medium-sized enterprises? These are all different forms of private credit. And the reality of it is, regardless of what the interest rate environment is, people need to finance. And so, of course, in the short term, movements in interest rates have an impact in short-term activity. But we're talking about the engines of finance that drive capital structure in a whole variety of ways. This is not something that's cyclically tied to short-term interest rates.
Yeah. Can I just get an update on how you see your consumer finance business, the pathway ahead for Goldman?
We've been very clear over the last few years that we're narrowing our consumer focus, and we've taken active steps to do that. We continue to have a very, very powerful deposit platform under Marcus, but we continue to take steps to narrow our consumer activity. And we're focused on our two big businesses, global banking and markets and asset and wealth management, and we feel good about the way we're positioned.
Well, we've been speaking for, I guess, like 15 minutes, and I still haven't brought up the big U.S. election coming up next week. Let me just ask you this, because as a bank, I'm sure you would have run scenario analyses on what will happen either way. What would you say is the biggest risk for your business for either outcome, a Harris win or a Trump win?
We're watching the election like everybody else. The good news is it's coming up, next week, and my hope would be, shortly after election night, we have a clear direction of travel in terms of what the next administration will be. Goldman Sachs is set up in position to help and support either administration, either outcome, and to support our clients in either of those outcomes. And so we're watching like everybody else. It's going to be a close election, and we'll see in the next couple of weeks what the direction of travel is.
Do you think it might have a direct knock-on effect on regulation and some of the regulatory stances taken?
There's no question that the regulatory pendulum has swung, pretty significantly over the last few years. My hope would be in either administration, there'll be a fresh look at how we can ensure regulation's important to keep guardrails in the economy and to keep our economy moving in an appropriate way, but at the same point, that pendulum can swing too far, and then it can become a headwind to growth. And I'm hopeful, on both sides of the aisle, there'll be a fresh look after the election to make sure we get that balance correct.
So that was the CEO of Goldman Sachs, David Solomon, there, speaking to Bloomberg's Jumana Bersace at the Future Investment Initiative Summit in Saudi Arabia. Now, a proposal to divide up the UK power market and provide free electricity in the windiest parts of the country is turning into a bitter fight with the biggest energy companies. Whether to keep Britain's electricity system as one national market or break it into regions with different prices is one of the consequential decisions looming for the Prime Minister Keir Starmer. Our energy reporter Will Mathis joins us now for more on this story. Will, why does this question matter, whether the UK is one national market or lots of little ones?
Yeah, this matters because the way the system is designed now puts a tremendous cost onto all of our bills. Right now, generators and consumers of power, trade with each other, irrespective of whether the power that's generated can actually be delivered to where it's needed. And so what happens is you have all these, wind farms up in Scotland that sell power. And then when it comes time to actually use that power, they can't provide it because the grid is insufficient. So the grid operator in the middle steps in and, pays some people to turn off and pays other people to turn on. And what happens is you have wind farms paid to shut off, and then you have gas-fired plants paid to shut on, and that to turn on, and that has a huge cost. During the energy crisis, it was over £2 billion just for that. And it's expected, according to some government studies, that could reach $8 billion by towards the end of this decade. So you have a real problem baked into the system, and this is one of the only proposals to address that problem and bring down this rising cost for consumer energy bills.
I mean, it seems like politically quite an easy sell, right? Consumers could potentially end up paying less as a result of this change, but what's the counter argument?
Well, there's two counter arguments. One is it's an easy sell to people, up in Scotland or parts of the north of England that will see very cheap power or even, free at sometimes. But if you're, like me and you living in London, and, that's where most of the population is and where most of the media outlets are, then, the price of power will rise because right now we're essentially getting, the bills are being leveled out, whereas like the market price of electricity in the south of England, where most of the demand is, should be higher. And proponents of this would say, have done modeling that shows that overall, if you, get rid of those costs, balancing the system, not just the power price, that overall it will be cheaper to make this change. But still, you will see power prices rise in the south of the country. And it's a complicated argument for a politician to make. And it's tough to make this argument based on, comparison to a counterfactual that hasn't yet happened.
What could this change, though, mean for investment in green energy, which we know is a key priority for the government?
Yeah, well, most of the companies that are doing that investment say that this is a really stupid idea. They say that, if you make this kind of fundamental change, then they're going to pause investment. They're going to have to reconsider the business case for these multi-billion pound investments in wind farms and grid infrastructure. Because, if you've built a wind farm in the windiest part of the country in Scotland, or you have planned to, and then all of a sudden, the power price is completely different what you thought it was before, then, they say we're going to have to pause to consider that, and some of the investments aren't going to happen, and it would just be disruptive at a time the government is saying we need to build faster than we've ever built before.
Talk us through the timeline of this decision process, because it's something that was put off by the previous government, but what are we expecting in terms of the next steps?
Yeah, so we're kind of waiting for a final decision now. There had been two proposals on the table. One was to do it's called a nodal system, which would be many, many different hyper-local prices, or to do what's called a zonal system, which would be dividing the country up into zones. Previous government said no to zonal. They said that would be too disruptive, but sort of left it open to deciding on a zonal system. They said that they saw benefits for doing that. and they were going to wait till a later date to decide. And people in the industry had expected that decision this year, but then there was an election. So now the expectation is that we should get a final decision on this early next year. But it's really fundamental to the the government's 2030 goal to decarbonize the grid, which is going to require huge investments. And what they do with this decision really dictate where those investments go.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.